Today I would like to analyze Mastercard, one of the largest credit card companies in the world. We can see here the stock price is up around 105% in the last 5 years. This is a strong performance, and we're going to take a look at the financials to find out if it's still a buy right now. The first thing we can recognize is a huge market cap of 486 billion US dollar. This makes Mastercard the third largest financial service company in the world. We also have a dividend yield of around 0.57%, which we can see here did grow in a good rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 15.3 billion US dollar. This was a 9% decrease from 2019. So this was related to COVID. Then we had the recovery with a growth around 23% in 2021. Then in 2022, we had the growth around 17%. Then in 2023, around 13% growth. And then 2024, around 12% growth. So overall, I think we had an incredible growth in the last 5 years. So it's a check here. The next thing you're looking for is free cash flow growth in the last 5 years, a very important number because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, we had a free cash flow around 6.9 billion US dollar. This was an 11% decrease from 2019, so again related to COVID. Then we had a strong recovery in 2021 with a 31% growth. Then in 2022, we had around 18.7% growth. So these are very good numbers in my opinion. Then in 2023, we had around 8% growth. And in 2024, around 23% growth. So overall, I think this is a good growth in the last 5 years. So we like to see that, and it's a check here as well. The next thing we're looking for is a free cash yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash yield, the higher the indication for our undervaluation. So what we're going to do now, we're going to take the free cash flow from 2024. This is around 14.3 billion US dollar. Then we're going to divide it with the current market capitalization, 486 billion. Then we're going to get the free cash yield for 2024. So the number we get is around 2.94%. So I think this is not a great number. It's under 4%, so we don't really like to see that. And it's not a check here. But this company can also grow the free cash flow. So we're going to take a look at the future free cash flow as well. Let's make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2025, the free cash flow could be around 14.7 billion US dollar. In 2026, around 16.3 billion US dollar. And 2027, around 18.8 billion US dollar. So I'm not sure if these numbers are realistic. So let's assume in 2027, we can reach around 17.5 billion US dollar. So let me know in the comments if this is a good number. Then we're going to divide it with the current market capitalization of 486 billion US dollar. So then we would get a free cash flow yield of around 3.6%. So I think this number is still quite low. So I think this is an indication for overvaluation right now. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So what we're going to do now, we're going to take the long-term debt first. This is around 17.5 billion US dollar. We're going to add the short-term debt as well. So we can see here around 0.75 billion. Then we're going to divide it with the current free cash flow, 14.3 billion. So then we're going to get the debt to free cash flow ratio for 2024. So the number we get would be around 1.27. So this is a great number. It means a little bit over 1 year we take to pay back the debt with the free cash flow. So the check here, we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. So we can see here around 8.7 billion US dollar. This is also a good amount, I would say. So I think this balance sheet is looking quite good actually. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. This is the market cap, 486. We add the debt. So the debt is around 18.25. Then we're going to take minus the cash. The cash around 8.8 billion. So this is then the enterprise valuation. Let's calculate this first. So the number we're gonna get is around 495.45. So this is how much the company is worth. We're going to add the debt and take minus the cash. So now we're going to divide it with the free cash flow that we had, 14.3. Then we're going to get the ratio that we're looking for. So now we're going to get is around 34.64. So I think this is quite high. This could be an indication for overvaluation right now, but we can also calculate for 2027. So then the number would look a little bit better as well. So we're going to take the free cash flow around 17.5. Yes. So then we're going to get a different number. So the number we're going to get for this year would be 28.31. So again, I think this company does look overvalued right now. Let me know in a comment if you think the same. The next thing you're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we're going to take a look and what we can see here. Yes, they buy back a lot of their shares. And actually every year since 2015. So this is incredible actually. They use a lot of money to buy back their own shares, and I think this helps the stock price a lot. That's why the stock price is up so much as well, I think. So yeah, sometimes over 2% in 2023, 2.5%, and now in 2024 around 1.4%. Yeah, so it's a check here. We like to see that, and I think they can do this as well because they have a quite good balance sheet. They have a good free cash flow as well. So I think yes, it makes sense for them to do that. But we should also understand that this company looks overvalued right now. So if this company buys back their own shares, I think it's maybe not the best move at the moment, because it makes more sense if the company is undervalued to buy back their own shares. I would like to give my conclusion about this company. So let's start with the positive. So I think we have a very good revenue growth in the last 5 years. We also have a good free cash flow growth as well. This is something we like to see. I think the balance sheet is also looking very good. We have a low amount of debt and a good amount of cash on hand. But I think the free cash flow yield around 2.94% is looking very low. This is something we don't really like to see. This can be an indication for overvaluation. Even if the free cash flow can continue to grow, probably in 2026 we would have the free cash flow yield around 3.6%. So I think it's still looking low about this. The enterprise valuation to free cash flow ratio around 34.64 is also looking quite high. This is something we don't like to see again. So this can be an indication for overvaluation. So even if the free cash flow can continue to grow, the valuation would be around 28.31. So still, again, this company looks overvalued with the current stock price. We also have a stock buybacks. This is something we like to see, but if this company is overvalued right now, I think it's not the best move to buy back their own shares. If you found this video helpful, don't forget to like and comment and subscribe for more content.